is here. Now, we've had scheduling issues. I think he's here. Todd's a busy guy. Managing Director of Land Coal Trading. There he is. He's here. Hi, Todd. Happy New Year.
Happy New Year to you.
I'm glad we finally were able to work this out. And you are a rock star tweeter, by the way. I am not good at it. You are good at it. All right. So
I'm just trying to promote the show.
Yeah, well, you're promoting yourself, and you should, because you're right. Because the last time we were here, you're the consummate bear started to turn bullish. And it's somewhat feeling like there's optimism in the air, isn't it?
Absolutely. And what really turned me was actually in September and October when I started seeing the retail sales numbers. I mean, they were lights out. They were beating Wall Street consensus. I know the retail numbers coming out today are very disappointing. But overall, though, there is a lot of optimism going into the new year, and I think it's going to maintain that way for several months now. Is it
U.S. equities, though, that are going to be doing it for us, or is it still our big multinationals? Are we still relying on emerging markets in China and big economies outside of our country to pull up our stock market?
You know what, I see it both ways, Tracy, is a couple of things. When you start thinking about the Federal Reserve and their quantitative easing, their second package, that really has improved the wealth effect. And we saw that in the fourth quarter of last year. People were out, they were spending money, and they were doing things that actually improved their wealth as far as, or at least giving the perception that they felt wealthier. We saw that in the equity market. And if anything, with higher equity valuations, that helped the household balance sheet. So there you go again, the wealth effect is there, or the improved wealth effect. Where we didn't see it, though, so much is with labor. The November report that came out a month ago was very disappointing. We have a big number tomorrow, and there are a lot of optimists out there feeling that we're going to see a very big number as far as growth in jobs, and that may very well be the case. But ultimately, though, the equity market for 2011 should do very well. The economy, though, is probably going to be that asterisk there that may not do as well as I think a lot of people are hoping.
Yeah, so again, we have that continued basic separation between Wall Street and Main Street, right? And it seems like Wall Street is poised to continue to do well. I mean, we've talked about this before, right? They are running mean and clean. They're still profiting. We're waiting, of course, to see that top line growth, but they are trimmed down. They're working with much less employees, and they're getting the job done. I'm not sure what the incentive is to hire unless, of course, you're talking about expansion. And are we really going to see that in 2011? So we'll see Wall Street rocking, but again, because of lack of expansion, that doesn't help Main Street.
That's right, and you're absolutely correct. I mean, just look at the third quarter earnings. You had 83% of S&P 500 companies that beat on the bottom line. Only 60% beat on the top line. The historical average for both is 62%. So you have a number of companies out there that have improved margins. They're not going out to hire. They have a ton of cash right now, and yet they're reporting great numbers on the bottom line. That is helping their stock, and their stock price, and that's going to continue this year and probably even deep into 2012. The issue, though, is about hiring. People are not hiring. We had the ADP number come out on Wednesday, and that showed a bump up in hiring for small and medium-sized companies. But your large Fortune 500 companies are not hiring right now, and they probably won't have to hire unless they start losing business. But the evidence just isn't there yet.
Right. So then that, again, doesn't help the jobs market. So what are the other things that could derail this sunny outlook?
$4 gas. When you start thinking about every $10 increase in oil takes out $1 trillion off of GDP. So when you start thinking about higher oil prices, higher gas prices, that kills discretionary income. So any improved wealth effect that is being generated by the Federal Reserve may become irrelevant because people are throwing all that money back into their cars. Where you're really going to start seeing this, though, is with autos. Because remember, when you think about auto companies, a big reason why one of these SUVs costs more money is because of the labor unions that are needed to actually construct one of these cars. There's obviously overhead costs that the auto companies need to meet. The point being is that going forward, though, you're really going to start seeing those larger cars, which is where the wider margins are for those auto companies. Those will probably start becoming quite thin, especially if gas prices start rising, as many believe they will.
Yeah, although I will say, we got to $4 once before, and you know what? We complained about it, but we still kept driving.
Yeah, but that was a different time, though. Remember that. It was summer of '08. Here we are. We're still in a very fragile economic state. I mean, we're on toothpicks right now. So you really don't want, and we have some improvement, so therefore you do not want something out there that could disrupt that, and higher gas prices would definitely do that.
That's fair enough. What about overseas? Any geopolitical issues that worry you going into 2011?
Korea. When you look at the Korean Peninsula right now, there definitely seems to be a hiccup there, and traders on Wall Street are very concerned about this. They're very vocal about it. You know, when you start thinking about China, the growth that's taking place there, if you have a hiccup in Korea, in that area, in Asia, that could disrupt growth in China. If that happens, and you're looking at obviously multinationals here in America would obviously take a hit. So therefore, that could be the one catalyst with the $4 gas that can really disrupt any type of bull run in the markets and really could be a start of a prolonged bear market.
Todd, I love you because you're so consistent and you still love the retail stocks. Ann Taylor's still on your list.
Yes.
ExxonMobil's been on your list before. Has Apple? Apple's throwing me for a loop right now.
You know what? I love Apple because I look at Apple. Everybody, obviously, it's a technology company. But when you think about they're geniuses in marketing and crafting that brand. You have the iPad 2 that comes out in April. You didn't hear very much about it during the holiday shopping season because Apple wanted all of their iPad 1s to go out.
Right.
This iPad 2, Tracy, is going to make the iPad 1 look like a 1980s Texas Instruments calculator. This thing is everything. The evidence, they're already leaking information about it. Apparently, it's supposed to have a video camera in it, super duper technology. This is great news, and it's great because the buildup is going to be there. Here we're 90 days away from this release, and everybody's going to be running to the store, waiting out all night for this iPad 2. That's great for Apple. It's great for their stock. Look for the stock to hit 400 by year end.
Yeah, because it's 334 right now. That's a big move. And what's really interesting is Apple is not at the electronics show right now out in Vegas. They are just mysteriously absent from the whole thing. So I guess they don't need to be at these things.
They don't need to be. It creates the mystery about Apple. It's their aura, their culture. You want that. You want people guessing, and the more people guess with that velvet rope approach, the more people want it. They want those Apple products. You go into any Apple store right now, Tracy, and they're packed. They're jam-packed. People are playing with the machines and everything else that they're selling. That's a great company. They're great at marketing, and they're great at elevating their brand, and you'll see that in the stock price by year end.
You're dead on. You know, I had to stop at the mall on my way home yesterday to return something for my son. It was probably 3 o'clock. The mall was vacant, except the Apple store. Wall to wall. It was the craziest thing I ever saw. Let's talk about these dollar stores. You still love them, too. Dollar General, Family Dollar, Dollar Tree, all still on your list.
Love it. Dollar General just announced the other day that they're going to hire 6,000 new employees. They're opening 625 stores this year alone. You know, when you think of the 3 main dollar stores, they actually increased their square footage by 5% last year, whereas you look at Target and Walmart, they remain flat. This is a growing, frugal future that we have right now, and people are going to the dollar stores, and they're going everywhere to the dollar stores. So I love all 3 of them, Dollar General, Family Dollar, and the other one, I'm sorry.
Dollar Tree.
All 3.
Dollar
Tree, that's right.
And you know what the good part about them is now? You're right in that not only are they expanding space, they're expanding product lines. I mean, you could get other things now. So I can buy toilet paper and paper towels and all that kind of stuff there as well. It's not just the junk you bought for your kids for $1. Finally, let's talk about housing real quick. You're saying stay away from it. You're saying stay away from buying a home, or are you saying stay away from the housing stocks?
Both. It's poison right now. First of all, it's always going to be a supply issue right now. The builders really did themselves a disadvantage by continuing to build these homes when people were not able to buy them. But it's a credit issue. You have 1 in 3 households in this country with a sub 620 FICO score. Who's going to qualify for one of these homes? Then we need to talk about the demographics. You have 27% of Americans right now are considered a head of household that are single. 1970, that was 17%. You have more Americans than ever offer under the age of 45 that are single. Single people don't buy single-family homes, and that only helps or only hurts supply issues because you have so many that are out there right now. And then you start talking about these jumbo homes, the $500,000 plus homes. Why would you put down 20% in cash on one of these homes in a depreciating asset when you could throw the money into the stock market right now and actually make a couple of bucks? Housing is poison. It's probably years away from recovering right now, and you really see it in the housing stocks. It's just too risky right now to go with.
You know, Todd, you're dead on. I'll tell you what, we're seeing it in New York City. We're seeing the very wealthy rent for that exact reason. We're seeing rents on very expensive apartments continue to go up and be occupied, and no one is buying anything. But we love buying what you say, Todd Schoenberger, Managing Director of Land Cold Trading. Thanks. I'm so glad this worked out. I'm sorry there was confusion. But as always, we love having you here.
Great to be here, Tracy. Thank you.
We'll see you soon.